Hi everybody, this is James Tompkins and welcome to Lecture 6 of the International Finance series. And sorry if you're bored with this, but I'd like you to know why we're doing what we're doing as opposed to, hey, here's just another topic. And so I'm going to start off with the typical question I ask, and that is, what is the overall theme of this class? International financial principles as it affects firm value. And value is a function of risk and return. And what element of risk are we looking at that one might associate with, say, international as opposed to domestic finance? Exchange rates, right? And so we spent the last several lectures focusing on and understanding why the dollar goes up and down in value. And I told, because that's the type of risk. And I told you that I would teach this from the American perspective. I focus on the dollar and so on and so forth, but we would use that as a platform for looking at other types of exchange rates and international risks. And that's basically what we're going to get into today. Other types of exchange rates and so on and so forth. So let me get into the agenda. And there it is right there. What do we mean by international monetary system? We'll find out that essentially it's an exchange rate system, and there are different types of exchange rate systems, free or clean or pure float, managed or dirty float, and fixed rates. And we'll get into the pros and cons of these different systems, and we'll look at how the government is involved, the government versus the market, and some of the issues that can occur with government intervention. We'll look at forecasting exchange rates. We'll discuss optimal dollar value, and it's a lot. That's what we'll be looking at today. So, as I mentioned, what is an international monetary system? Well, what do you think of when you think of the term international? Well, different countries, presumably, right? And what do you think of when you think of the word monetary? Well, how about money, right? So money between countries. So basically, it's a system that determines exchange rates. So, for example, how are we going to decide that, say, it takes 7.8 Hong Kong dollars to buy a US dollar? Okay, what systems are in place that determine that is the exchange rate? So that's basically what we're going to look at today. Now, as I mentioned, there are different types of exchange rate systems. There's the free or clean or pure float, and managed and dirty float, and fixed rate. And so we'll kick off with the first one. So what do you think I mean by a free, also known as a clean, also known as a pure float? Well, this is definitional, right? So it's not understanding. Either you know it or you don't. It's like I don't understand why the sky is called the sky. I've memorized that the sky is called the sky. Okay, so here it's the same thing. Basically, by definition, it's where pure market forces determine an exchange rate. So in other words, does that mean there is or is not any government intervention? There's no government intervention. It's kind of like, say, Apple stock price. Okay, Apple stock price goes up and down, and it goes up and down according to market forces, and you don't have the US government, for example, buying and selling Apple stock. So my question to you is, do any such currencies exist? Well, the answer, I guess, is no, but probably the closest I guess it's no in that there have been times where governments that very rarely intervene in the markets, and we'll talk about how they do that later. But the fact that there are currencies that exist that governments very, very rarely intervene in the markets, and so some of the closest, I'll show you some examples in a minute. But basically, it's where exchange rates go up and down according to market forces. So there's, for example, dollars per euro. I start this off when the dollar got into being. So this is January 1st, 1999, and it goes all the way to a relatively recent time period. and that's dollars per euro. Now, here's a question for you. Could that be a stock price? It could, right? And so basically, any chart that you see like that looks like it could be a stock price is basically, I'll ask you, going to be dominated by market forces or dominated by government forces? Dominated by market forces. If we look at this one for a little bit, you can see, for example, that when the euro came out of the starting gate, that the euro weakened or it strengthened. It weakened, right? Because it took fewer dollars to buy a euro down the road. It got close to around 80 cents per dollar, and then we've had this sort of long term of dollar weakening or strengthening. Dollar weakening, where it's taken more dollars to buy a euro. Here's another example: yen per dollar. Now we'll discuss this later. But the Japanese government is a government that has attempted to intervene in the international markets or the currency markets. And like I said, we'll discuss this later, but a quick point here is again, could this look like a stock price? It could, right? And so when I say they've attempted to intervene in the financial markets, I really shouldn't say attempted. They have intervened. But who does it look like who won? Does this look market dominated or government dominated? Probably market dominated, right? So like I said, we'll discuss government intervention a little bit later as far as the Japanese yen is concerned. So let's move on to managed or dirty float. So a pure or free or clean float, that was pure market forces. What do you think a managed or dirty float is? Do you think it's pure market forces still? Is it all government? Maybe a mixture of the two? And that's what it is, right? It's basically a mixture of the two. A combination of market forces and some degree of government intervention. For example, they've got these terms. They've got smoothing out daily fluctuations. That's where the government, they're going to not try to oppose fundamental forces, but they're going to try to act as some sort of smoothing agent. They'll intervene to make the daily fluctuations maybe a little bit less sharper than they otherwise would be. Another term is a little bit more forceful, leaning against the wind. This is where the government will basically temporarily oppose fundamental forces. And by the way, why would governments do this? Well, I mean, is rapid change, would you argue that's higher risk or lower risk? That's higher risk, right? And so presumably their thought process is, well, if we slow down that change, then the environment is less risky. And we'll discuss that in more detail also. But do you see any problems with the government trying to, if you will, temporarily oppose forces that are even fundamental? Well, how does the government know what a fundamental force is? They may not, right? And by the way, who do you think is more attuned to what a fundamental force is, the market or the government? Well, if you believe the market, then that's even more of a problem. But in any case, that's what leaning against the wind is. Now, there's also this thing called unofficial pegging, which is a type of managed or dirty float. What do you think unofficial pegging is? Well, basically, the government is pretty involved, and they fix the exchange rate, but they don't admit it. I mean, let me give you an example. I remember one time, a long time ago, I was teaching this class in Trinidad, graduate students. And I said to them, it looks like the government intervenes in your exchange rate. And they all looked at me and they said, no, that's not true. Our government doesn't. Are you kidding? No. And I said, well, yeah, I mean, of course they do. So my point is that if it is true, and I don't know if it is or it isn't, I'm just sort of using the student's reaction, but if it is true that the Trinidad government doesn't admit that they intervene in the foreign exchange markets, then that would be, but in reality they are, that would be an example of unofficial pegging. So here's their chart, and you can tell me, does that look like it could be a stock price? I mean, not really, right? I mean, can you imagine? I mean, look at this. That's a span of what, a couple years, whatever. Can you imagine Apple stock being unchanged, literally unchanged for 2 years? You can't, right? So there's something going on here, right? And what's going on is government intervention. So in any case, that's an example, or that's potentially an example of unofficial pegging if it is true that the Trinidad government says, no, we don't intervene, and in reality they do. So let's talk about fixed rate systems. So what do you think a fixed rate system is? Well, would the exchange rate change in a fixed rate system? It wouldn't, right? So basically a fixed exchange rate system is where the government intervenes in the market to keep the exchange rate as a straight line. I mean, for example, the Hong Kong dollar. They've been fixed at 7.8 Hong Kong dollars per US dollar since 1983. That's decades. So, for example, here's the Hong Kong dollar, and as you can see, it's a straight line. This starts at January 1st of 04 and goes all the way to a relatively recent time period. But that straight line actually goes all the way back to 1983. So that's an example of a fixed exchange rate system. So what are some potential advantages of a fixed exchange rate system? Well, let's say that I'm an importer. Okay, maybe I import tennis nets from Hong Kong. Okay, I wouldn't, but let's say I do, right? So if I can rely on the notion that the exchange rate will never change, am I removing an element of risk from that business activity? I am, right? And if I'm removing exchange rate risk, and I'm not giving up any reward, because I'm in the tennis net business, right? And the risk is built into the tennis net business, then would that be happy face or sad face? Be happy face, right? And so if it is true that an exchange rate was a straight line, fixed, and you could count on it being straight line, would that promote trade? It would, right? And to the extent that trade is a win-win situation, if you believe that, then that would be an advantage. Could the same concept, by the way, also apply with investment? So for example, I live here in the United States, right? And if I buy Apple stock, then I'm taking on risk that the Apple stock will go up or down, unexpectedly or unexpected compared to what I thought it would do. Okay, and so that's risk, right? But if, say, a European buys Apple stock, are they taking on 2 levels of risk? They are, right? Not only are they taking on Apple stock risk, but they're also taking on exchange rate risk. So in any case, an advantage of a fixed exchange rate system is that it promotes trade and investment, which is great, right? And there are some other nuances which we'll get to a little bit later, but that's just a preview. But my question is, well, if a fixed exchange rate system is so great, then why don't all countries do that? Well, as we'll find out, depending upon what kind of fixed exchange rate system we're talking about, some are subject to sudden overnight devaluations. So in other words, you might wake up one morning and find out, hey, so sorry, but when you went to bed last night, everything was fine, but when you woke up this morning, well, the value of money was worth 60% less than it was the night before. Okay, so that sudden potential for a big change represents a big disadvantage, potentially, depending upon the type of fixed exchange rate system we're talking about. So in any case, you could argue that floating rates are more transparent because at least you see them going up or going down or whatever, just like we see with, say, Apple stock. So let's get into how do governments intervene in the market? What do they do? And what I'd like to do is I'd like to use Zimbabwe as an example. And what I want to get into is Zimbabwe in a time of rising political and economic risk. And I'm going to go back a long time. What I did was I kept track of some old articles, and back in 2000, I'm just reading an old Wall Street Journal article here, and this is dated June of 2004, and it says the Zimbabwean government announced Tuesday that all farmland will be nationalized and private land ownership abolished. And if I read on, it says since the farm seizures began in 2000, so this kind of stuff is going on in 2000, about 200 black families have been allocated former white-owned land. That's how they refer to the races there, black and white. Since 2000, the often violent seizures of white-owned commercial farms, along with erratic rains, have been blamed for disrupting production in the agriculture-based economy, leading to acute shortages of food, hard currency, gasoline, and other imports. If I read on, critics say much of the best farmland was given to supporters of President Robert Mugabe and is underutilized or lying fallow. So, for example, it says at the very end, UN crop forecast predicts Zimbabwe wants a regional breadbasket. In other words, they used to be a net exporter, will produce only half of its food needs this year. And there's, the nationalization program was likely to further hurt the alien economy by frightening away what little investment Zimbabwe still received. Okay, so my only point of this is to point out that as we go through this whole thing, is to point out that Zimbabwe was going through a period of increasing or decreasing risk. Increasing risk. And by the way, just in the interest of full disclosure, my goal is to teach this in an unbiased and objective fashion. But I should disclose that I had, he's passed now, an uncle that used to live in Zimbabwe, an aunt, and he was actually a member of parliament, and he was actually asked to run by Mugabe. And I'm not an expert on Mugabe by any stretch of the imagination, but my understanding is that he was actually a pretty good guy, and then at some point he decided to, I guess, run on a race platform, black, white. Although, I don't care what color you are. If you're hungry, you're hungry. In fact, in Zimbabwe, they started a whole nother political party, the MDC, the Movement for Democratic Change, with lots of black and white people in that party. And my cousin, he still lives there. He has a boat building business, and so to the extent that stuff is relevant from that, I'll bring that in. But in any case, for the sake of full disclosure, I wanted to mention that. And but again, my goal is to obviously try to teach this in an objective fashion. So we've set the stage that starting around 2000, Zimbabwe is risk increasing or risk decreasing? Risk increasing, right? Now, if you look at the number of Zimbabwe dollars, here we are in 2000 beginning, and it's around 38 Zimbabwe dollars per dollar. Okay, and then what's going on here? Well, that's what's called a what? Devaluation, right? Because all of a sudden, on an overnight basis, all of a sudden it goes from 38, all the way up to about looks like 48, 49. Okay, and then they keep having these devaluations, and so we got to think about, well, what's going on here? Why is that happening? And then here we are, we're around 57 Zimbabwe dollars per dollar, and then as you can see, this is in '03. April '03. As you can see, there's another devaluation which happened shortly after an election. Okay, so let's see what happened in Zimbabwe. Okay, so here we are in from '02 to '03. It's from 57, around 57 Zimbabwe dollars to dollar. Remember earlier, like in 2000, it was 38. And so here's my question: if the Zimbabwe dollar, I'm just denoting that Z, was subject to pure market forces, then do you think the Zimbabwe dollar would have weakened or strengthened? It would have weakened, right? Why? Well, because number one, let's talk about investment. Okay, are they in a risk increasing or risk decreasing environment? Risk increasing, right? And do you remember what balance of payments account the investment happens? That's the capital account, right? So if everybody's, to the extent that they're allowed to, say capital controls, if everybody is trying to take the money out, or if nothing else, they're not putting any more money in, what that means is that there is more of a demand for the Zimbabwe dollar by other countries to invest in Zimbabwe, or less of a demand? Less of a demand, right? And so that would mean that if the Zimbabwe dollar was subject to market forces, then that would be Zimbabwe dollar weakening or strengthening? Weakening, right? And let's look at their imports and exports. What account was that in? That was in the current account, right? So it says that once they were the regional breadbasket of Africa. In other words, they would supply Africa with food. They would export. And when they exported, was there a demand for Zimbabwe dollars by, say, South Africa? There was, right? Which would be Zimbabwe dollar weakening or strengthening? Strengthening. But now they engaged in policy where people would be assigned these farms, they'd take over these farms, and the problem is they didn't know how to farm. And so they went from being a net exporter of food to a net importer. And when they import, is there more of a supply of Zimbabwe dollars for sale in the exchange rate market? There is, right? So for example, let's say they imported food from South Africa. Well, they would need to, ultimately the South Africans would want rand, right? South African rand. And so they would need to go onto the exchange rate market and say, hey, we'll sell our Zimbabwe dollars to buy the rand, to buy the food. So ceteris paribus, anytime you have an increase in the supply of anything, what happens to its value? It goes down, right? So in other words, both in the current account and the capital account, as far as the Zimbabwe dollar is concerned, with this rising risk situation, is it happy face or sad face for Zimbabwe? Sad face, right? At least from a Zimbabwe weakening thing. But the government's saying, hey, we want to keep that Zimbabwe dollar steady. We're trying to have a fixed rate, right? So the question is, how does a government, or in this case Zimbabwe, intervene in the markets? So what I've done here is I've inverted the scale just for intuition. So imagine this red line is basically what the markets would be doing to the Zimbabwe dollar if it was solely subject to market forces. So this represents, hey, we're gonna weaken the Zimbabwe dollar. You're no longer exporting, and there's no longer foreign investors that want to invest in you. And in fact, if anything, to the extent that they're allowed to, they're taking money out, etc., etc. So the government they're engaged in something, in government intervention, and I'll call it, or you can assume that when I talk about government intervention, I'm talking about direct government intervention. Government intervention in the exchange rate markets, the example I'm about to give you, is direct, because obviously there are other things that the government can do that would indirectly affect the exchange rate and influence it. But when we refer to government intervention in the exchange rate markets, it's along the lines of what I'm about to tell you, and it's direct. Okay, so the government's doing something. So what does the government do? How can they do that? I mean, what can they do to keep this on this straight line of 57 Zimbabwe dollars per US dollar? Well, how would they create a demand for Zimbabwe dollars? I mean, they personally, the Zimbabwean government. Well, what if they bought Zimbabwe dollars? Okay, well, sure. Ceteris paribus, if they became an entity that say, hey, we'll buy those Zimbabwe dollars, ceteris paribus, would that make the Zimbabwe dollar rise? It would, right? But what would they use to buy those Zimbabwe dollars? In particular, if they were trying to keep it at 57 Zimbabwe dollars per US dollar. Well, presumably they'd use US dollars. So what they're doing here, what's going on, is they're buying Zimbabwe dollars with whatever US dollars they have. By the way, in what account does that happen? In what balance of payments account? That's the change in official reserves, right? So here they are. They're buying Zimbabwe dollars with US dollars, which means they have more official reserves or fewer? Fewer, right? Because they're spending their US dollars. By the way, just to track back to the discussion we just had, so we have risk increasing. So let's look at the current account. So we've got farms that are being taken over by people who don't know how to farm. So instead of exporting, they're importing. So is that Zimbabwe dollar weakening or strengthening? Weakening, right? And then with this risk increasing stuff, are there fewer foreign entities that want to build breweries in Zimbabwe, per that example, or invest in Zimbabwe? They are, right? And so if anything, to the extent they're allowed, they're going to pull their money out, right? So if there's less of this going on, is that Zimbabwe dollar weakening or strengthening? That's weakening, right? So you've got weakening stuff going on in the current account, weakening stuff going on in the capital account. So to try to keep it strong, they use their official reserves. So when I talk about government intervention in the exchange rate markets, what am I specifically talking about? In what account? The change in official reserves. Okay, again, I recognize there are other things that the government can do that indirectly have an impact on their exchange rate. So, for example, they could. What if they said, you know what, we're going to let the markets rule again. Okay, we're not going to confiscate property, or we're going to allow land to be privately held again. Okay, would that be risk increasing or decreasing? Well, presumably that'd be risk decreasing, right? So that would make foreign investment more likely or less likely? More likely, right? Which would make the Zimbabwe dollar strengthen or weaken? Make it strengthen, right? So in any case, but that's indirect. Direct is down here in this account. Hey, we're going to buy those Zimbabwe dollars. We're going to create a demand for it, and we're going to do it with US dollars. So that's how, for example, a government, in this case Zimbabwe, would intervene to keep their exchange rate artificially strong. So, can you think of any problems with trying to keep the Zimbabwe dollar artificially strong? I mean, could they do this indefinitely? They couldn't, right? Why not? Well, think about what they're doing. They're using US dollars to buy Zimbabwe dollars. Do they have an unlimited supply of US dollars? They don't, right? I mean, eventually they'll run out of US dollar reserves. So in other words, what they're doing is temporary. And so when they do run out or come close to running out of those reserves, then what do you think they're going to be forced to do? Well, in this case, they're going to be forced to say, hey, we can't maintain that 57 Zimbabwe dollars per US dollar anymore. So we're going to have to devalue. And that's what happened. Now, this is not always the case, but do you think a devaluation is generally politically popular or unpopular? Well, to the extent that it's unpopular, then would the devaluation more likely happen before or after an election? After, right? I mean, again, I get back to the example of, suppose you, imagine you look like a rich guy. Yeah, okay. Imagine you have $100,000 in your account. And you go to bed and you wake up the next morning and the government says to you, so sorry, but, now what is worth, the value of your account is now worth $40,000. Okay? That'd be happy face or sad face? That'd be sad face, right? So a devaluation is generally unpopular. It's sudden, overnight change. Now, having said that, that's not always true. I'll segue, really quickly. So, for example, it used to be, in fact, even recently, you could argue that countries around the world, they've been wanting their currencies to go down in value. And they've been doing that in different ways that I won't get into right now. But when the currency goes down in value, let's say Italy, is it easier or harder for Italy to export its shoes? It's easier, right? But in any case, in Zimbabwe's case, guess what? Here's the election, and shortly after, a devaluation. Well, let's see what happened. Okay, so here we are. We're in 2003. The exchange rate is about 57 Zimbabwe dollars per dollar. Remember, just 2 or 3 years earlier, it was 38 Zimbabwe dollars per dollar. On April 25th, they devalued. Any guesses for the new exchange rate? 814. An overnight 93% drop. If we go on, so now the exchange rate's about 805. And in February of 2004, they had another devaluation. Any guesses? Would you believe 4,000 Zimbabwe dollars per dollar? And then another one jumps to 5,200. Then we have that article I read you. Okay, so that was June of 2004. They announced their intention to nationalize all farms, abolish private land ownership. Again, ceteris paribus, would that make the Zimbabwe dollar weaker or stronger? Weaker, right, if it was subject to market forces. So for Zimbabwe to maintain a level, they're having to, use more and more of their reserves and to buy back Zimbabwe dollars. But as we said earlier, that is or is not sustainable. That's not sustainable. So a year later, there's another devaluation. Now we're up to 9,000. And so then they have a brilliant idea. They say, hey, this is kind of inconvenient. All these banknotes. I know. We'll just knock off 3 zeros. So in 2006, they say, all right, well, 1,000 old Zimbabwe dollars is now 1 new Zimbabwe dollar. And if you read the articles back then, the finance minister was just saying, hey, this is brilliant. But does that create wealth? When you artificially just knock off some zeros, does that create any wealth whatsoever? It doesn't, right? It's like when a company splits their stock. Okay? I mean, I know that there are other issues going on, like information effects and so on and so forth. But if we ignore that, okay, imagine the value of a firm is, say, $1,000. Okay, so the value of a firm is $1,000, and let's say it's all equity. Okay, so let's say it's 100 shares at $10 per share. Okay, so here we have $1,000, that's the value of the firm, and it consists of 100 shares at $10 a share. And the company decides to split its stock. Let's say it does a 2-for-1 stock split. So instead of 100 shares, now you have how many shares? 200 shares, right? So now they go to 200 shares. Okay. So when they have 200 shares, are those 200 shares still going to be worth $10? They're not, right? They're going to be worth $5. Okay, the 200 shares are going to be worth $5. Why? Because 200 times 5 is $1,000. That stock split does not create any wealth. And it's the same thing right here. When a government decides, you know what, I'm gonna knock off a few zeros, that doesn't create any wealth. Anyway, if we go on, a couple years later, they knock off 10 more zeros. A year later, 12 more zeros. And a little bit later, 5 more zeros. And so let me ask you this. At this point, is money losing its meaning? It is, right? I mean, I'll give you a quick example. I remember when my cousin turned 50, and my aunt from South Africa and my cousin, so his sister, they went up to visit them in Zimbabwe and to celebrate his 50th birthday. And so they went out to dinner, and he literally had to take a suitcase full of money. And so basically the money was just it lost its convenience. I mean money has a convenience, right? We'll talk about that more when I talk about foreign exchange markets, but there's a convenience element to money. But if it loses this sense of stability, then does it become more useful or less useful? Less useful, right? And so then finally, basically, the government was forced to say, all right, we give up. We can't sustain this. And so they said, all right, we're going to allow you to start trading in other currencies. And by trading, I mean when you go to the store, it used to be you had to use Zimbabwe dollars to buy bread or whatever. And they said, all right, well, we'll allow you to use dollars or euros or whatever. Now, they never formally, to my knowledge, I could be wrong about that, but they never formally said, all right, we're getting rid of the Zimbabwe dollar. But was that essentially a death blow for the Zimbabwe dollar? It was, right? Because, hey, imagine you're a business person and you're like, say, my cousin with his boat building business, okay? Gosh, I have the choice of paying my workers in Zimbabwe dollars and we're talking about $50 billion notes and who knows what it's going to be worth tomorrow, etc. Or I can use the US dollar, or I can use the South African rand. What do you think they'll do? Well, obviously, they would use one of those other currencies, right? If we continue the story, they continued to increase political risk. And so they said, all right, guess what? If you're a foreign company and you're valued at more than 500,000, you have to sell 51% of it to locals. Is that risk increasing or risk decreasing? That's risk increasing, right? So any guesses to where it ended? Remember, we start at 38. You see there a number of 373, right? But guess what? We got to add in all these zeros, right? And if you add in all the zeros, it would look like that. I don't even know how to say that number, okay? A gazillion whatever, okay? It's a big number. And of course, I've mentioned it's obsolete today. Let's think about inflation, okay? What would you expect to happen to inflation during this time period? Go up or go down? Go up, right? I mean, they had hyperinflation. Let's think about why, okay? So as the Zimbabwe dollar is getting weaker, let's say they buy a loaf of bread from South Africa, okay? To change Zimbabwe dollars into rand to buy the bread, With the Zimbabwe dollar getting weaker, would they need more Zimbabwe dollars or fewer Zimbabwe dollars to buy the rand, to buy the bread? More, right? And when something costs more, then what do we call that? We call that inflation. And in Zimbabwe, it was unbelievable. I mean, that's obviously a hyperinflationary rate. In 09, and again, that's another number I can't say. I remember reading a quote one time, and again, I'm not sure how official this is, but prices would double every 25 hours. When I asked my cousin, well, how do you do business in this hyperinflationary environment? Well, he faced a couple problems. Number one, he had a tough time getting materials for his boats. In fact, customers that would come to him and say, hey, I want you to build me a boat, he would say, fine, but you need to get me the materials. Well, can you imagine going to a Ford dealership or whatever and wanting to buy a Ford car and going in and they say, yeah, sure, you can buy a Ford, no problem, but hey, we're a little short of, tires and actually, if you wouldn't mind finding, a steering wheel and by the way, this is embarrassing, but we don't really have any engines. You get those things and yeah, we'll sell you a car. What does that do to the cost of doing business in that kind of situation? Skyrockets, right? Obviously. Another problem he has, he remembers telling a story in that contracts were extremely short term. Okay, so for example, and I may have the numbers wrong, but he had locked in a price that was just 1 day long. It was the price for, let's say, steel. Okay, I don't remember what it was, but price for steel at X number of Zimbabwe dollars per ton or whatever the units were. And but it was only good until noon the next day. So he sends one of his workers to get the contract. He has to get signed by noon the next day. And the guy had a flat tire on the way. And because of that flat tire, he didn't make it by noon. And because of that, the steel ended costing millions more dollars than otherwise would have. And what do you think another big disadvantage of trying to do business in a hyperinflationary environment is, as a businessman or woman? Well, basically, you lost the luxury of thinking about stuff. Okay, he couldn't go, well, let me think about whether or not I'll buy this steel or whatever it is. That luxury went out the window. So here's my question. Now that the Zimbabwe dollar has basically gone, then what do you think happened to inflation? Do you think it continued to skyrocket or went down? Well, it basically went down. Shortly after this time, here's a July 2013 quote. Again, that's according to the Bank of Zimbabwe, and it may or may not be good information, but as you can see, inflation of 1.25%, significantly down. By the way, here is an example of one of their notes. That is a $50 billion Zimbabwe bill. Am I rich? No, afraid not. In any case, so that is an example of, a country basically bankrupting itself, right? If we go back to the balance of payments, I'll just draw one real quick. Okay, go back to the balance of payments, Zimbabwe strengthening, Zimbabwe weakening. We have the current account, we have exports, imports, we have the capital account. Okay, so basically they are doing what? They're importing more than they're exporting, or vice versa? They're importing more than they're exporting, right? And as I mentioned in the balance of payments lecture, when you import more than you export, so you have a current account deficit, well, when you import, are you buying or selling? You're buying, right? And when you export, are you making money? You're making money, right? So are they buying more than they're spending? Are they buying more than they're earning? They are, right? They're living beyond their means. So sad face here. We saw in the balance of payments lecture that you can get away with that if you're an attractive place to invest in. And it's like you personally, right? So if you're in a situation where you're currently spending more than you're making, maybe you're in school or something, how can you bridge the gap? Well, one way might be to borrow money, which happens in the capital account. But there was sad face here and there was sad face there. So imagine you personally. Imagine you're spending more than you're making, and you bridge the difference with say borrowing money. Okay, so imagine that in a given year, maybe you spend $50,000, but you're only making $30,000. So you have to borrow $20,000 so you can pay your rent and so on and so forth. Now, eventually, is the bank going to get fed up with lending you money? They probably will, right? Especially if there's no sign or indication that you're ever going to graduate or whatever. And it's the same thing with Zimbabwe. Okay, and basically you could argue they went bankrupt. In fact, at one point, or let me back up. When they were printing money, do they have to pay a company for the service of printing their money? They do, right? And this was a German company. And at one point, they were so broke that they could not raise the money to pay the German company to print their money. And so basically, in the end, by going through this whole process, they lost their monetary policy power because nobody uses Zimbabwe dollars anymore. Then printing Zimbabwe dollars doesn't really do them any good. Remember, monetary policy power, the ability of a government to print their money and to raise and lower interest rates, they lost that. Another recent example, by the way, is Venezuela, with the Chavez regime. He died in 2013, but did they go through a risk increasing or risk decreasing environment? Risk increasing, right? And to the extent that was risk increasing, would that attract or repel foreign investment in Venezuela? Repel, right? And so over that period of time, would you expect the Venezuelan bolivar to strengthen or weaken? Weaken, right? And here's the Venezuelan bolivar. As you can see, he's starting in 01 here and going through a recent time period. So you can see they're trying to keep it fixed, right? But every now and again, there's a devaluation. I don't know what these spikes are. Maybe somebody pushed the wrong button or something. I don't know. But in any case, you can see this as weakening, right? Because we're down here around, say, we start off at 670, and now it takes 6,600 bolivars to buy a US dollar. So that is examples of governments trying to keep their currency artificially strong, right? So Zimbabwe was trying to prop up their dollar, same with Venezuela, but eventually they ran out of reserves. Let's talk a little bit about Japan. How does the government intervene in the market to fix the rate? And here's another example, okay? So Japan has intervened in the markets on a number of occasions, to try to make the yen weak. Now, why would Japan want the yen to be weak? Well, to the extent that they are a net exporting nation, okay, which by the way isn't always true, but that's been primarily true, okay, then ceteris paribus, is it going to be easier for them to export with a weaker yen or a stronger yen? A weaker yen, right? Why? Well, let's say we, the US, want to buy Toyotas from Japan, and they want 20,000 yen for their, or 200,000 yen for their Toyotas. Well, if the dollar is strong relative to the yen, which means if the yen is weak relative to the dollar, then will we need more dollars or fewer dollars to buy the 200,000 yen to buy the car, the Toyota? fewer dollars, right? And if we need fewer dollars, are we more likely or less likely going to buy their cars? More likely, right? And so that's the motivation for them to keep the yen artificially weak. Now, how do they do that? Well, first of all, what account do they do it in? Well, what's the account where it happens in a direct basis? The change in official reserves, right? So basically, they use yen to buy dollars, right? So, hey, here's an increase in the supply of yen for sale, and we're going to buy dollars with it. Ceteris paribus, anytime you increase the value of anything, or the supply of anything, what happens to its value? It goes down, right? Now, if we look at the chart, this starts, again, the same time the euro did, just sort of randomly picking that time, and going all the way through to a relatively recent time period. And if we look up here we are 120 yen per dollar, and it goes all the way down to close to 100 yen per dollar. Now, does that look like a pretty steep drop? It does, right? Now, is that the yen weakening or strengthening? That's the yen strengthening, right? Because it's taking fewer yen to buy a dollar. So in this time period, was the Japanese government intervening in the exchange rate markets to try to weaken it? Well, it turns out they were, right? In fact, anytime you see a steep drop here, and I'm going just on memory, they were. And so the question is, well, does it look like they were being relatively effective or ineffective? Ineffective. Why? Because if they had been effective, would they allow this sharp drop? They wouldn't, right? And by the way, why are they even trying to manage their whole economy with exchange rates? Why not? Well, what do we do in this country when we're trying to manage our economy? Well, that's when the head of the Federal Reserve will raise or lower interest rates, right? So, for example, what kind of economy would you prefer? Okay, would you prefer an economy like this, where you have booms and busts and booms and busts, or gradually maybe increasing growth, or you know, not as big dips and so forth? Well, presumably you'd rather have just gradual growth, right? I mean, managing an economy like this, you know, boom and bust, I mean, you're hiring people and you're building those factories and you're training them, and now you're laying them off and you're closing those factories. Is that an expensive way to run your economy? It is, right? Which is why the government, when the economy is growing too quickly, what will they do to interest rates to slow it down? They'll raise interest rates, right? There are a couple, you know, key rates that they have control over, which presumably have a ripple effect with other interest rates. And they'll announce interest rate increases. And when they announce interest rate increases, what happens to the cost of capital? Does it go up or go down? It goes up, right? And when it goes up, does it make it more likely or less likely that it'll be positive net present value for companies to build those new plants or hire those new people? What makes it less likely it'll be positive net present value, right? And so therefore, when the government raises interest rates, does that make the economy grow more rapidly, or does it slow it down? It slows it down, right? So if the economy is growing too rapidly, you might raise interest rates to slow it down. What if you're heading into a recession? What if, you know, what if the economy is going into recession? What would you the economy is going into a recession? What would you do with interest rates? Would you raise or lower them? You'd lower them, right? And again, the thinking is the opposite. You would lower them because, hey, does it make the cost of capital more or less expensive? Less expensive, right? And if it's less expensive, then a firm's more likely going to build those new plants and hire those new people, or less likely? More likely, right? So if we get back to this exchange rate chart and we get to times like this, why isn't the Japanese government simply lowering interest rates to boost their economy? Why are they messing with the exchange rate market when you can clearly see that what they did was not very effective? Well, they did actually lower interest rates, and after they had a booming time period in the 80s, and I think it was around 1989. Basically, that bubble burst, and they lowered interest rates. Except, how low can you lower interest rates? How low can you go? Well, basically, pretty, around zero. And I'm hesitating a little bit because that's virtually true. But let's just say, for intuition's sake, zero. It's not really pragmatic to go lower than zero. So in other words, once your interest rates are around zero, do you lose some degree of monetary policy power? You do, right? And so basically what they did was, well, let's try to use the exchange rates to grow our economy. We'll try to weaken the yen. But as you can see, effective or ineffective? Ineffective, right? So what are some potential problems with using the yen to buy the dollar? So here they are, that they're taking the yen, and maybe they print them, or maybe they have them in the back room, or whatever. But when they take those yen and they go to the exchange rate markets and they buy dollars, are there more yen out in the economy or fewer yen out in the economy? More, right? And ceteris paribus, when you print money, or when you have money that's out there in the economy that wasn't there before, then what do you risk? You risk inflation, right? Now, in Japan's case, that has not been a problem. So, but nevertheless, just to get the point across, it's potentially a problem. By the way, what is inflation? Well, obviously it's when prices go up, right? But really, there's a logic to thinking about situations where inflation is a logical outcome. So, for example, imagine this $1 bill is all the money in the world, okay, all the dollars that's out there in the economy. And imagine this pen is the only thing that this money can buy. So this represents the economy, if you will. Then how much will this pen cost? Cost $1, right? So imagine now that the growth of money doubles. So now there's $2 out in the economy, but the economy hasn't grown. So what the only thing you can do with this money is buy this pen. So now what is the price of the pen? It's $2, right? And so basically, inflation is a logical outcome when the growth of money exceeds the growth of what you can buy with it. Now, in Japan's case, they've been tottering on the brink of deflation. They've been worried about that, and we'll talk about that in a future lecture. But in any case, if Japan was concerned, then what could they do to reduce the risk of inflation? How could they take that money back out of the economy? So remember, they've got this yen from under their mattress, or they printed it, or got it out of the back room, whatever, and they've taken it to the exchange rate markets, and they bought dollars, right? So they've increased the supply of yen back out in the economy. Okay? So what could they do to take it back out? They could borrow it, right? And how would they borrow it? Well, they would issue T-bills. What kind of T-bills? Yen T-bills, right? So literally what they're doing is they're saying, all right, so imagine, I know it's not, but pretend that's yen, right? So I owe you 1 yen. Okay, so basically what they're saying is, okay, so if I'm a Japanese guy, and this is Japanese yen, and here's the government's saying, all right, hey, you take this, I owe you 1 yen, this piece of paper, and give me, the government, the money. And so that's how they take it out of the economy. Okay? Now, what is the problem with that? Well, when you borrow something, do you eventually have to pay it back? You do, right? So in other words, from that perspective, could you argue that if you were worried about inflation, which again, Japan, that was not the case, but if you were, then would that just be a temporary solution to avoiding inflation? It would, right? In any case, that does bring up a couple of definitions of sterilized versus unsterilized intervention. So if we look at the actual intervention itself, what did Japan do? Well, they used yen to buy dollars. Okay, so they used yen to buy dollars. Okay, and that was the intervention. Okay, now if they then issued yen T-bills, okay, if they do both, if they issue yen T-bills in addition to, of course, using yen to buy dollars, then can you guess what that's called? Do you think that's called sterilized intervention or unsterilized? Well, when you think of inflation, does that bring happy face thoughts or sad face thoughts? Well, that brings sad face thoughts, right? So, when you think of something that's sterilized, is that clean? That's a good thing, right? So basically, if you do 1 and 2, that's called sterilized intervention. And if you just do 1, that's called unsterilized intervention. So that's basically an example of what a government does to weaken its currency. Now, if we continue with types of fixed rates, as I've already mentioned, we have the ordinary peg, we have currency boards, we have dollarization. So let's get through some examples. So Zimbabwe, that's what's known as an ordinary peg. When a country has the unrestricted ability to print their own money and so on and so forth, then that's called an ordinary peg. Of course, we saw what happened in Zimbabwe's case. Now, here we have the Hong Kong dollar, also an example of an ordinary peg. And if you look at the Hong Kong dollar, right, as I mentioned earlier, that's been at 7.8 Hong Kong dollars per US dollar since 1983. So here's my question. How is it that Zimbabwe, they've devalued, and yet Hong Kong held steady even during the Asian crisis? In fact, if we look at the Asian crisis of the mid to late 90s, it started off with, I think, the Thai baht, Thailand, their currency devalued, and then the Malaysian ringgit devalued, and etc. But the Hong Kong dollar, just held steady. Any thoughts? Well, they're a fixed rate system, right? But they're a different type of fixed rate system. The Hong Kong is on a fixed rate system called a currency board. So what is a currency board? And either this is something you don't know, you don't know, and so I'll just tell you what the system is. Okay. So here we have Hong Kong fixed at 7.8 Hong Kongs per dollar. So here's my question: if they only allowed out in the economy the number of Hong Kong dollars that they could back up in their official reserves with the US dollars they've committed to, then could they ever run out of official reserves? So in other words, imagine there's 7.8 Hong Kong dollars out there in the world, and they have 1 US dollar in their official reserves. Could they always back up that exchange rate of 7.8 to 1? They could, right? And that's basically the currency board system, where you can only print or allow out in the economy what you can back up with foreign reserves. Let's take Argentina. I use Argentina because the number is a little bit simpler, but Argentina used to be on a currency board system. They had a rate of 1 Argentinian peso per US dollar. Now, in theory, with a currency board system, interest rates adjust automatically. Let me show you why using the Argentinian peso. Suppose there are 1,000 pesos out in the world economy, and they have exactly 1,000 US dollars in Argentina official reserves. Now, it could be it doesn't have to just be dollar official reserves. It could be anything that made the $1,000 equivalent. But I'm just working with dollars to make it simple. Okay. So suppose I say to them, hey, so I'm in the world. I say, hey, I'm going to give you one of my pesos, and you give me back $1. Okay. So at this point, how many pesos are left in the world economy? Remember, I gave them one of my pesos. Well, 999, right? And how many official reserves do they now have if all they had was $1,000 and that was it? 999, right? So could they now take this peso and spend it? They couldn't, right? Because if they spent it, then how many pesos would be back out in the world? 1,000, right? But how many official reserves would they have? Well, 999. Okay. And so basically they couldn't do that, and so because of, well, there's 999 pesos left out in the world, and they have $999 in official reserves, and so in any case they can't print it. So now let's look at the interest rate. Okay. So there are fewer pesos in the world, 999. So if I wanted to borrow pesos, would the banks demand a higher or lower interest rate with fewer pesos out there? Higher, right? And what if I wanted to deposit some pesos? If I were willing to deposit some pesos in a bank, would I require a higher interest rate or lower? Higher, right? And so basically what we see is that in theory, therefore, interest rates adjust automatically with a currency board system. So what we have is that a country that's on a currency board system, they do or they do not have the same degree of control over their interest rates as a country without a currency board system. They don't, right? And what about the ability to print money? They do or do not. Can they freely print money like Zimbabwe did? They can't, right? So if they lost their monetary policy power, they have, right? So let's look at pros and cons of a currency board system. Okay. So with a fixed exchange rate system or with a currency board system, or say Hong Kong, okay, if the exchange rate risk is perceived to be negligent, in other words, Hong Kong has had the same exchange rate since 1983, and so that the market really has a lot of trust in that it's going to stay at that level. Does that make trade more attractive or less attractive? More attractive, right? Because as we discussed earlier, you don't have to worry about exchange rate risk. That's one less element of risk. And could the same be said to be true for investment? It could, right? So in other words, a currency board system is going to promote trade and investment. Now, what about a potential disadvantage? And I say potential disadvantage. A country with a currency board system, have they given up a lot of their monetary policy power? They have, right? So if they're trying to manage their economy, does it make it easier or harder? It makes it harder, right? For example, earlier I said, well, imagine that the economy of the United States is growing too quickly. Then what could the head of the Federal Reserve do to interest rates to slow it down? They could raise it, right? Or if we were going into a recession, what could they do? They could lower rates, right? But with a currency board system, your interest rates adjust automatically, and you're not free to print money. So here's my question. Notice I said this was a potential disadvantage. So from that perspective, it's a disadvantage, right? But for what kind of country would losing that power actually be a good thing? One that is more prone to corruption or more prone to economic versus political conflicts of interest? Because if you think of that Zimbabwe thing, right, could one argue that that whole situation is political versus economic conflict of interest? You could, right? So, I mean, for example, and I'm making this up, I could be wrong, but was it good or bad for the economy to put people in place that didn't know how to farm in Zimbabwe? Presumably that was bad, right? And so that would be where the people got hurt. But on the other hand, is it possible that the motivation for Mugabe, and again I could be totally wrong here, I don't know, but is it possible his motivation was, well, he thought that's how he could get more likely re-elected or whatever? In other words, I'll put my cronies or my friends in these farms and etc. In other words, is there potential for political versus economic conflict of interest? And there is, right? And so in any case, what kind of country would you want to have this power? This monetary policy power? One that uses it wisely? In other words, to control the economy, so you have maybe gradual economic growth as opposed to booms and busts? Or one that is prone to corruption and it's just going to print money like crazy and try to buy votes and eventually, as in Zimbabwe's case, basically drive them essentially into bankruptcy? So in other words, a potential advantage of a currency board system is, well, all right, we admit it, we're a country, we can't handle this kind of power. There's too many times where we have regimes in place that will abuse this monetary policy power, so we're just better off not having it. On the other hand, a disadvantage is, hey, we're a country where we can use this monetary policy power wisely. And if we go to a currency board system, then we lose that tool. So what about Argentina? They, as I mentioned, they had, notice I put that in the past tense, they had a currency board system for about 10 years there. And then in January 2002, they devalued their currency. Look at it right here, right? So here, this straight line down here, 1 peso per US dollar, that had gone on for about 10 years. And then overnight, they devalued. And as you can see, they've become weaker and weaker. So if they were on a currency board system, how is it that they were forced to devalue their peso? Well, guess what? They cheated. No, if you call it cheating, they borrowed the foreign reserves. And guess what? When you borrow something, eventually you have to do what? Pay it back, right? So maybe this too was political versus economic conflict of interest. So what could you do, or what kind of system can you think of that would be even more of a commitment than a currency board system? Well, here we have the sucre. Let's see what happened to the Ecuadorian sucre. I mean, here it is around, looks like, what, 7,000 Ecuadorian sucres. This is back, again, starting when the euro started. And they're weakening or strengthening here. They're weakening, right? And at one point it hits about 25,000 Ecuadorian sucres per dollar. And then boom, all of a sudden, whoa, what's going on there? Any thoughts? Did they all of a sudden become really strong? They didn't, right? They did something called dollarize. Okay, now dollarization is exactly like the currency board concept, where you have at least the number of official reserves to back up the exchange rate that you're trying to stick with by having that correct balance in what's out in the world versus what you have in official reserves. The concept is identical, except they're taking a step further. They're saying, look, you know what? We'll just get rid of our currency. We won't even use, in this case, sucres anymore. In fact, if you go to Ecuador and you go to a grocery store now, guess what you're paying? You pay in dollars. And so what this means is, well, can Ecuador print dollars? They can't, right? So they too have given up a lot of their monetary policy power, and unlike a currency board, is this more of a commitment? Or I should say, compared to a currency board, is this more of a commitment? It is, right? Because this is a lot less reversible, right? I mean, you can't, they couldn't all of a sudden, hey, you know what, we'll just go back to the sucre and we'll sort of a sneak surprise attack. It would take years to plan that. And so dollarization is a type of fixed system where you're really making a commitment to the outside world that you're not going to be as subject, if you will, to conflicts of interest, political versus economic conflicts of interest by the way you use your money and so forth. So let's look at China. Now, when you look at China, does this look like it could be, I mean, yeah, we have a fixed exchange rate system, but even this, you know, that sort of gradual downward curve, and then we have this straight line and more of a gradual downward curve. Does that look like it could be a stock price, or does that look pretty controlled? That looks pretty controlled, right? And so in the summer of 2005, you know, the China said, all right, well, we're gonna start allowing our yuan to do what? Is it strengthening or weakening? It's strengthening, right? So they're up here around 8 yuan per dollar, and they've just gradually been taking fewer yuan to buy a dollar. So in July of 2005, they began this process. And so here's my question for you. Because earlier, when we looked at Japan, we said Japan was relatively effective or ineffective in their intervention in the exchange rate markets. They're relatively ineffective, right? And China's not on a currency board or anything, and they haven't dollarized, but it looks like they have a lot of control or little control over their exchange rate. It looks like they have a lot of control. So here's my question. How is it that China, that has an ordinary peg, how have they been able to keep it fixed or controlled? Well, let's look at their balance of payments. Okay? So here I have the Chinese balance of payments, one strengthening on this side, one weakening on that side. Current account, exports, imports. So let's look at their current account. Now, do they have a net current account surplus or deficit? In other words, do they export more than they import or vice versa? Well, they're a net exporter, right? I mean, they sell, you know, all kinds of stuff, okay? And so from a strengthening point of view, is that happy face or sad face? You could argue that's happy face, right? To the extent that they're making more than they're you know, spending. Or forget the happy face, sad face. We'll just say it's net yuan strengthening. Okay? Now, what about their capital account? Do you think that China is an attractive place to invest in? It is, right? And they've enjoyed periods of capital account surpluses. So unlike Zimbabwe, right, where they're spending more than they're making and nobody wants to invest them, et cetera, and eventually they go broke, okay? You know, China's the opposite. Okay, they're earning more than they're spending, and they're an attractive place to invest in. Okay, so both of those are one, strengthening activities or weakening? Strengthening, right? But if they want their yuan to be artificially weaker than all this strengthening activities, then what would they be doing to keep their yuan artificially weak? Well, first of all, in what account does that happen? In the change in official reserves, right? So they'd be basically taking yuan and selling them to buy US dollars, which means they have more official reserves or fewer official reserves? More, right? In fact, you know, you could look this up. You know, they are by and far the nation with the most dollar official reserves of any of the nations out there. That data comes out about every 3 years, I think, by the banks of international settlement. But Google it, and by the way, Google their capital account surplus too. And so in any case, they've been accumulating these masses and masses of official reserves. Now, by the way, what's one of the things, they don't have to do this, but when they sell yuan, they buy dollars. So that's the intervention part. What's one of the things they do with those US dollars? They put them under their mattress? No. What's one of the least risky things they could do with those dollars? They could turn around and then invest it in US T-bills, right? And that's one of the things that they've been doing with those dollars. But we'll talk about that in a minute. But in any case, what it means is that, yeah, if China is sort of a winner here and a winner here in the current and the capital account, it means they have a lot of control over, well, we'll just put our exchange rate where we want it to. And they've been gradually allowing, I use the word allowing their currency to weaken. Now, you may have heard, and this is related, that China has been called a currency manipulator. And I'm talking at least by politicians in the United States. And I'm talking about Democrats and Republicans. I think Bush called the Chinese currency manipulators, and I think Democrats have, etc., etc. It's sort of a political hot button. Now, why do you think they call the Chinese currency manipulators? Well, basically, the idea is that China has been keeping their currency artificially weak or artificially strong. Well, the argument is artificially weak, right? They've been allowing it to strengthen, but according to the level that they want to. So artificially weak. And so when the yuan is artificially weak, does that make it easier or harder for them to sell their stuff? Easier, right? Because, for example, if we buy Chinese toys, do we need more dollars to buy the yuan, to buy the toys, or fewer? Well, we need fewer dollars, right? So that's the argument for keeping it artificially weak. Now here's my question for you, okay? What specific action has China engaged in to keep their currency or their yen artificially weak? If it is indeed artificially weak, which for the sake of argument, we'll assume it is. What specific action? What account did they intervene in? What account does government intervention happen in? Happens in the change in official reserves account, right? So in other words, China has used yuan to buy dollars, right? This is, China has used yuan to buy dollars. So is that not true is that not true of Hong Kong? Have there been times when Hong Kong is engaged in the exact same action? Or in fact, I can give you an example during the Greek debt crisis. Okay, during the Greek debt crisis, when investors wanted to have investment in Europe but not the euro, they said, yeah, well, we'll invest in the Swiss franc. And so if everybody wanted the Swiss franc, then what do you think was happening to the value of the Swiss franc? Was it weakening or strengthening? It was strengthening, right? And the Swiss at some point said, well, hey, enough's enough. We don't want our currency to strengthen anymore. I mean, will that make it more likely or less likely people will ski in Switzerland if the Swiss franc becomes very strong? Less likely, right? Because people will need more euros to buy the Swiss francs to ski in Switzerland. And what about selling their chocolate? Is it easier or harder for them to sell their chocolate? It's harder, right? For the same reason. People will need more euros to buy the Swiss francs to buy their chocolate. And so what Switzerland did was basically, all right, you know what? We're going to print a whole bunch of Swiss francs and we're going to buy euros. Okay, so use Swiss francs and buy euros. Right here. Use Swiss francs to buy euros. So here's my question to you. Is that the exact same action that China is doing, except obviously with their currency. Is it any different? It's not, right? I mean, it is the exact same action. And I'm not trying to defend or support China. I'm just being objective. My point is that, do you hear politicians calling Switzerland, oh, you currency manipulator? You don't, right? And so why would politicians sort of beat their chests or whatever and say, gosh, China, you're a currency manipulator and you better allow your currency to strengthen? Why would they do that? Well, here's the thought process. The thought process is, well, or one thought process, and one is flawed and the other is not flawed, okay? But one thought process is that, well, if the Chinese yuan strengthens, then does it make it more likely or less likely they'll buy stuff from us? More likely, right? And that part's not flawed. I can understand that. And if they buy more stuff from us than ceteris paribus, does that mean we get more jobs or fewer jobs? Presumably more jobs, right? And so that's the line the politicians are selling. Hey, China, you better allow your currency to strengthen because that'll be good for jobs in the US. But, and I'm not arguing against that, but except for this point, and that is when the Chinese yuan strengthens, then, you know, presumably it's also strengthening against some other currencies, and they're free to buy stuff from other countries too, right? So, you know, so how much more are they going to buy from us? But here's the other thought process, and this I would argue is flawed, and maybe you can tell me why. And that is, hey, China, you better allow your currency to strengthen because, you know, if right now the yuan is really weak, and so, you know, people are buying from you, and we want people to buy from us instead, okay? And so if you weaken your yuan, and let's say I have a friend who imports tennis nets from China, and so let's say that the yuan strengthens, and does that mean that he needs more dollars to buy the yuan, to buy the tennis nets, or fewer dollars? More dollars, right? And so the politicians are saying, oh, well, great, well, then he'll buy his tennis nets from the United States. Well, is that true? I mean, think about it. What competitive edge or what does China have to offer? Why bother buying tennis nets from China? Well, presumably one thing is that cheap labor, right? So here you are, you're the American businessman that imports tennis nets from China because they have cheap labor, and you go, I wonder, what is my second choice for cheap labor? United States? No, I don't think so. You know, maybe Vietnam, maybe Thailand, right? So from that perspective, you know, that's a flawed argument. So when we look at China that has gradually allowed, again, I use the word allowed, their currency to strengthen, do you think they've done it because they've been called currency manipulators, or do you think it's more likely they've done it because it's in their best interests? Well, maybe a bit of both, but arguably probably in their best interest. And so why would they do it? Why would it be in their best interest? We've already seen that it would help or hurt their exports. It would hurt, right? But would it help their imports? It would, right? Because they wouldn't need as many yuan to buy dollars to buy our stuff. It would help, and so I guess one point would be, well, if you're a nation that has had a current account surplus for decades, does that mean you've been earning more than you've been buying for decades? It does, right? And so would you expect the pendulum to swing at some point to where instead of becoming an economy that's export driven, that eventually it would become more consumer oriented like it is in the United States? I mean, think about you personally. Imagine you spend decades and you save up money for retirement, and say now you have this big nest egg. What are you eventually tempted to do, and probably eventually do? You retire, right? You start making money, you start spending it. So from that perspective, you could argue that a stronger yuan would be better or worse. From that perspective, you could argue it'd be better. But what's another thing? Well, what if they were worried about inflation? Which they have been, right? Because as their economy has grown like crazy, if everybody is being hired and fired and they're opening new factories and et cetera, is ceteris paribus inflation more likely or less likely? Well, you could argue it's more likely, and I'm hand waving a little bit. I'm being somewhat oversimplistic, but you could think of, well, now there's more money in people's pockets, et cetera, and so it's easier for prices to go up. But in any case, let's look at the role. If they're worried about inflation, which they have been, then would a stronger yuan make inflation more likely for them or less likely? Less likely, right? So for example, if they buy, let's say Ford needs $20,000 for one of their cars, and they buy a $20,000 Ford. Well, with the yuan strengthening, do they need more yuan to buy that Ford or fewer yuan? Fewer, right? Which means the price of that Ford in yuan has gone up or gone down? Gone down, right? And so if Ford is coming in with cheaper price in yuan cars, then what does that do to the competition of say local Chinese car manufacturers? Are they forced to keep their prices low? Well, presumably they are, right? And if that's the case, then is inflation more likely or less likely? Less likely, right? Now let me bring up one point. I call this my fingers crossed point. And that is, I think of this whole politician thing, whoever it is, I think of them, say somebody's coming up to want to be president or whatever, keeping their fingers crossed and saying, all right, China, you better allow your currency to strengthen. But they're keeping their fingers crossed. Again, I'm making this up. They're keeping their fingers crossed and thinking, but please wait until after the election. Now, why might they do that? What would be a thought process? Well, think about this, okay? When they are weakening their currency, are they engaged in this action right here? Use yuan to buy dollars? They are, right? And that's the intervention. But now they have a bunch of dollars, so what might they do with the dollars? Well, one of the things that they might do with the dollars is to buy US T-bills. In other words, to lend us money, lend the United States money. In fact, when they're in the process of doing that, ceteris paribus, what does that do to our interest rates? And I'm not talking about interest rates that the government raises or lowers. I'm talking about on a market-driven basis. What does that do to, say, our T-bill rates? Well, let's say the United States needs to borrow $1 million, so they issue $1 million T-bill, and everybody's saying, hey, I'll lend you the money, I'll lend you the money. Everybody's just dying to lend us the money. Then what happens to interest rates under that scenario? Will they be low or high? They'll be low, right? Because everybody's saying, yeah, we want to lend you the money. And in fact, as with China, keeping their currency artificially weak and therefore being a major buyer of our US T-bills, that's just one, there's plenty, but that's one of the areas where the finger has been pointed where our interest rates have been kept artificially low, and that had an impact on mortgage rates, which had an impact on the housing crisis, etc. But that's another topic. So getting back to this, politician, fingers crossed, you better allow your yuan to strengthen. That means they'd be doing more of this or less of this? They'd be doing less of this, right? Let's say they just cut it out altogether. Use yuan to buy dollars. They'd say stop buying dollars. And they stop buying dollars, Are they going to do more buying US T-bills or less? Less, right? Let's say they decide, you know what, we're going to stop buying US T-bills because we're going to let's say they announce, okay, we're going to let our currency float. So now the market knows that there's one more entity that does not want to lend us any money, does not want to buy US T-bills. Well, based on that announcement, what do you think would happen to interest rates? They'd go up, right? Because the United States, they still need to borrow money. So let's say they want to borrow $1 million. Now, well, I don't really want to lend it to you. No, nobody wants to lend money. So on a market-driven basis, what would have to happen to interest rates to bribe investors into being willing to lend us money? They'd have to go up, right? Well, if interest rates go up, then what does that do to our economy? Does it make growth more likely or less likely? Less likely, right? And it might even throw us into a recession. So getting back to the fingers crossed thing, if you're a politician and you're trying to get elected, and China says, all right, well, we're gonna stop being a currency manipulator, and we're gonna stop keeping our yuan artificially weak, and by the way, we don't want to invest in your T-bills anymore, therefore, and so interest rates skyrocket and the economy goes into recession. Well, what does that do to a politician's chances of getting reelected, especially a president? Makes it less likely, right? And so that's why I kind of think in my mind, fingers crossed, just wait until after the election. So that was basically a discussion on international monetary systems. I want to bring up just two more quick side topics, and that is forecasting. So what we've seen at this point is that when it comes to an exchange rate, is it fair to say that there are market forces involved as well as government or political forces? Presumably, yes, right? So let me draw a quick diagram. You say market and political versus political or government or whatever. And let's say you got a free floating and you've got a fixed. Okay. Okay, so here we have market forces, political or government, floating or fixed. So in both cases, for floating, are market forces important? They are, right? And would you say government and political forces important for floating? Well, they are, right? Because they're going to have an impact too, right? I mean, the government, it could be indirectly, right? And the government, let's say the U.S. government decided to lower tax rates. Would that make the dollar, ceteris paribus, weaker or stronger? Well, probably weaker, right? I mean, stronger, because would we be a more attractive place for foreigners to invest in if they pay lower taxes at the corporate level? Presumably we would, right? And what about fixed? Is market relevant? It is, right? Is political relevant? It is, right? But relatively speaking, for which one is political more important? Probably fixed, right? So this might have a bigger check mark. Why? Because who is it that decides when the devaluation is going to happen? The market or the government? The government, right? And so you could say that relatively speaking, that from a relative sense, you could argue that this political stuff, as far as forecasting, is going to carry more weight, whereas with floating, it's probably more market. Let me talk about one more thing, and that is the optimal dollar value. What is the optimal value of the dollar? So if I went to, let's say I had 10 different quote-unquote experts, okay, and these guys are just, and women, they're top in the world, okay, and I say to them, hey, what do you think the optimal value of the dollar should be? Well, what do you think they would say? Or do you think I'd get one single answer? I'd probably get 10 different answers, right? But what about this? Do you think they could agree on the following? Suppose, what picture do you think they would prefer? Okay, picture A, where the dollar gets very strong, then very weak, very rapidly, or picture B, where there's less dollar volatility? Well, presumably, they would prefer picture B, right? Because if you look at picture A, let's talk about up here when the dollar's really strong. When the dollar's really strong, if you're an exporter, is that happy face or sad face? Well, that's sad face, right? Because if the dollar's strong, and let's say Russia wants to buy Caterpillar's tractors, do they need more rubles or fewer rubles? Well, they need more rubles, right? So will they buy fewer Caterpillar tractors or more? Fewer, right? So when the dollar's, when the dollar is really strong, then exporters is going to be sad face. And what about importers? Happy face or sad face? Happy face, right? Because if you're an importer and the dollar's strong, let's say you're importing French wine, then do you need more dollars or fewer dollars to buy the euros, to buy the wine? Fewer, right? And could the same thing be, could the opposite stuff be said for a weak dollar? So here we have the dollar strong, here we have the dollar weak. So exporters, happy face, importers, sad face, right? So basically we have the opposite here, right? When the dollar is weak, well, that's happy face, because now if you're Caterpillar and you want to sell tractors to Russia, do they need more rubles or fewer rubles? They need fewer rubles, right? And now if you're the French wine importer and you want to import French wine, do you need more dollars or fewer dollars to buy those euros, to buy the wine? More dollars, right? So here's my point, okay? So here we have the dollar, it's getting stronger, and if you're an importer, you're hiring people, etc., and now you're laying them off as you go back down. And again, same kind of thing. Is that an efficient or inefficient way to manage your economy? Inefficient, right? And so what, and there's a couple other areas that you could argue the exchange rate has an impact on. So for example, what about inflation? If you're worried about inflation, then is a stronger dollar happy face or sad face? If you're the US and you're worried about inflation, it's happy face, right? Because if the dollar is strong and you're bringing in, say, BMWs from Germany, then do you need more dollars or fewer dollars to buy those BMWs? Fewer, right? Which means higher prices or lower dollar prices? Lower dollar prices, right? And so, therefore, from that perspective, that would make inflation less likely. And so my point is that, there are pros and cons to whether the currency is weak or strong. But what most economists would probably agree on is that ceteris paribus, they'd rather have less exchange rate volatility than more. Now, if you're in my class, then what we'd be doing is obviously looking at real-world current events. There's just tons of stuff out there. And I would strongly encourage you to look at current events and to relate the kind of stuff that we're learning here to what you're reading about in the real world. In any case, the goal today was primarily international monetary systems. So we spent a whole bunch of time understanding why the dollar goes up and down in value. And I said I would use that as a springboard to look at other types of exchange rate systems, which is what we've done today. And so we'll continue to look at other reasons for why the dollar goes up and down in value in following lectures. And as always, I hope this has been a good learning experience, and hope to see you at the next lecture. Thank you and goodbye.